Welcome to this Conveyancing Matters chat when Lorraine and Stu will discuss 100% mortgages, yes or no. Welcome to Conveyancing Matters with Lorraine and Stu. Join us for a chat about all things property. So, Stu, how are you, mate?
I'm very good, Lorraine. How are you?
Yeah, I'm all right, thanks, love. So, we've not actually done a little YouTube chat for a little while now for various reasons, but we thought we'd come back with a bang, and Skipton have handed one on a plate to us, haven't they, Stu? 100% mortgages, 100% loan to value, Stu. So this Conveyancing Matters chat, 100% mortgages, yes or no? So for the benefit of the anybody that's less than age 50 watching this, Stu, what's 100% mortgage, first of all?
Well, basically, if you're buying a property for £350,000, you can borrow £350,000. Amazing.
Yes, so 100% loan to value, basically a mortgage product where the buyer doesn't have to put down a deposit. They've presumably got to find their legal fees and their stamp duty, land tax, if any is payable, land reg, etc. But the good old deposit doesn't have to be put down. And Skipton Building Society, there's been a lot of reporting in the media and the mainstream media as well as the property press too, hasn't there, over the last couple of weeks? 100% mortgages, particularly and exclusively, to be fair to Skipton, for current renters. Yes. So, I mean, just to quote from Financial Reporter, which I actually think is a good source of this information, and they are telling us that Skipton Building Society have launched this product, Stu, as I say, exclusively for current renters. It's a 5-year fixed rate of 5.49% over a maximum of, here we go, 35 years. It's available to tenants who feel, and I quote, trapped in the rental cycle and are over the age of 21, subject to affordability and credit score, plus evidence of a minimum of a 12-month good track record rental history. And of course, the big theory behind this particular product, Stu, isn't it, is the fact that people are often, say, well, I'm paying, £800 or £1,000 a month, rent, and I've paid it month in, month out. It would probably cost me less to get a mortgage. Why can't I get a mortgage? So that, I think, is the theory underlying the product. I mean, unsurprisingly, Financial Reporter report that mortgage brokers think it's a great thing. And as I say, to be fair to Skipton, it's a specific product aimed at a specific part of the market. But what are your kind of initial observations from?
I mean, when I looked at the Skipton product, I did speak to a number of brokers that we currently deal with, and you've outlined the main criteria. That being that it has to be a 12-month assured short hold tenancies and no other types. And you have to also evidence the payment that you're making in terms of the rent going out of your current account. And importantly, the amount of the rent must be on or more than the mortgage payment. So I think, Skipton are trying to protect themselves. But what concerns me is that, yes, it's a good news story. Yes, it will probably generate, more people making mortgage applications. Yes, it would help first-time buyers. But of course, we can't ignore the problems that arose back in sort of 2008-ish with the volume of 100% mortgages, particularly Northern Rock, I think, were pushing. It wasn't just 100%, it was 110%. Can you believe even 120% you could borrow?
It's extraordinary when you think about it.
It is extraordinary, and especially for the younger viewers, what's equally as extraordinary is that at that point, a lot of the banks, and it wasn't solely because of these mortgage products, but some of the banks almost went bust at that time, and the government had to bail them out. And Northern Rock in particular were a casualty, and they were, of course, the main perpetrator of offering these kind of mortgages. But they carry absolutely enormous risk because of market conditions and purchase price fluctuations. And I've seen so much gumph over social media, whether it be from estate agents, brokers, expressing their delight at the news. Yes, it is good in some circumstances, but you've got to be so careful. And the word that doesn't seem to be spoken about, or two words, is negative equity. And what happens, when you have a problem, maybe, the market was to dip, the economy gets worse, all of a sudden you could be made redundant and you could end up with a property actually, that has more borrowing than its value.
Yeah, I think the thing is,
that risk is really important.
It absolutely is, and again, you mentioned the 2008 crash, but I'm well, obviously, my nan told me about this too, but I'm old enough to remember the property crash of the early 90s when I just qualified. In fact, just to just to let everyone know how old I am. And exactly the same thing happens. And I think what people forget, we have operated in this very, very, very strange bubble for the last 3, 4, 5 years, when a lot of people have come into the conveyancing a work arena during that time. And it's not fair to say, well, you're not old enough to remember this stuff. Well, I mean, of course they're not, but I completely agree with you that nobody, and it's always that thing that we say that, we don't want to talk down the market. Of course we don't. But, an air of realism about this. And kind of, what I've been thinking privately for a long time is that with the sort of exponential increase in property prices stroke values over the last few years, I mean, and interest rates in general being as low as they are, I mean, you don't need to be an economist to work out that, property prices will come down, and indeed are doing, and interest rates will go up, and indeed are doing. And similarly, there was a significant property crash in the early 90s. And as you say, a lot of negative equity. And what people forget is that, of course, the most aggressive part of that market in the equation in that scenario, of course, are the very lenders who've sort of perpetuated the problem, arguably, by lending people too much money in the first place.
Yeah.
So, if someone struggles with their mortgage payments, whether it's 100% mortgage or less, but if they can't pay, at the end of the day, the lenders aren't charities, and they are going to repossess. And if they sell at a loss, there we've got the negative equity. Or people are just trapped, so they continue to pay over the odds, and they stay in a property that, as you rightly say, Stu, they can't move, they can't leave and move from, because it's the property would sell for less than they owe on it. And what concerns me about this from the conveyancer's point of view, and of course, we always have to remember the stuff that, you and I would go banging on about, that, property lawyers, solicitors, licensed conveyancers, we are not qualified to give financial advice. No. We cannot give financial advice. And I would want to stress quite clearly, we're not. But we can give generic comment. And I do think conveyancers should be looking very closely at their sort of standard mortgage reports to make sure that these risks are really, properly highlighted. And that clients sort of understand that as the loan to values ratios creep back up, possibly, to 100% if you're a renter, that, as you say, and I think conveyancers should do it as that little sum, shouldn't they? Buy for 250, borrow 250. Next week the property's worth 220. You're in negative equity, and I just think that's I think that's a risk that conveyancers need to be very clearly outlining to their clients and making sure.
Do you think it's a strange time for this product to be released?
I do. I really do.
We're on the cusp of not quite knowing where the market is. I was surprised at the time, and I've always thought, I suppose, at one point, during our careers, that it was inevitable that higher loan to value would come back in. I have to admit, I never thought I'd see 100% mortgage realistically. I thought maybe 95% mortgages on a rising market. But yeah, I'm surprised at the timing of it, because of course, we're not out of the woods. We don't quite know where we are. You've still got the war in Ukraine. You've still got, interest rates rising. I would have thought it's a risky time to release the product.
Yeah, I mean, it's interesting, isn't it? Because, again, Financial Reporter, to give them that, to give them their due, quotes the CEO of home financing at Skipton, and of course they are, I think, sort of quoting Stu the very unusual set of circumstances that we find ourselves in that, cost of living crisis more generally, fuel costs, and the fact that people are just finding it almost impossible to get on the property ladder. And of course, quite frankly, a separate story, I suppose, really, is just the difficulty that some people are having, even being able to rent a property. So there's actually a whole strata of people there that if they can't rent, they can't access this product. So my guess, and it's no more than a guess, I have nothing to back this up other than my hunch, is that other lenders are going to sort of push the envelope, and the loan to value rates will creep back up. But I think that what conveyancers need to be doing is to be very alive to the risk, because of course, Stu, you'll remember that every time there's a property crash, dip, whatever we want to call it, and the lenders start to take a hit, it's the good old insured conveyancers that they're going to be running after.
Lorraine, you're 100%, and this is where the devil's in the detail. And what worries me is some of the conversations I've had with some certain estate agents where they've actually gone on the theory that actually the length of the product makes it protective. When I said, well, what do you mean? They said, well, in 5 years' time, the prices will 100% have gone up. They might well dip initially, but they'll 100% go up in 5 years, and they'll probably be worth way more than the amount borrowed, so it won't be an issue. But of course, that's not, not where we are. My worry is you take the mortgage, and of course, all of a sudden, the economy or for whatever reason, personal circumstances change. Let's just say you get made redundant, you can't afford to pay your mortgage, and the banks take possession. You're right, that's what happens to the client. But what happens to the conveyancer is when that bank takes possession of that property and they are looking at a potential loss, the first person they will look at will be the lawyers that acted on their behalf.
Absolutely.
And the advice that was given to the client. And if that's not watertight, they will be looking at you in relation to those costs.
Yeah,
and I can remember we had a number of Northern Rock mortgages when they were in difficulty. And I can remember actually our files being called upon for auditing.
Yeah.
The bank actually asked for a copy of the file to audit them. Now, nothing ever came of it, luckily. But who's to say that this time round, it's years and years later, the world's a different place,
Yeah, and I think what also a lot of our colleagues don't realise, Stu, is that some lenders, I would guess, a very significant proportion, they have departments whose only raison d'etre is to get hold of conveyancing files, to go crawling through them when there's a problem with the lending, to see whether we gave a supposedly incorrect or
we've said it
non-advice, and to give the lender a wedge into the firm.
Yeah, and we've said this 100 times, I know, so we don't want to keep repeating ourselves, but, the client in those circumstances doesn't have any money, okay? So you don't get blood out of the stone. But, of course, what do the lawyers have? They have indemnity insurance, okay? That's why we become the easy target. I know we said it 100 times before.
I think it's absolutely
what the rationale will be.
It's the thread that runs through really Conveyancing Matters, actually, Stu. We're coal-faced conveyancers. You in particular, you've got the burden of the indemnity insurance. You absolutely are at the coalface and understand what this means. And I find it pretty much every single training session I offer, I do say to somebody, do remember that your firm is properly insured. You're the only person that's properly insured on all this. That's why somebody will have a go at you. And of course, the interesting thing I think about the potential negative equity thing, I say not to talk it down. I mean, I do actually quite admire Skipton for trying to come up with something to help a specific sector of the market. I mean, and fair play to them. I'm not criticising them per se for that at all. As you say, it's just the wider risks. But of course, interestingly, we know that the lenders will have a pop at us. But to be fair, I think the consumer/client is a very different beast today than it was in 2008 and 1991. And I think if anybody, any client, any buyer, ends up, without a house or in negative equity, well, they too are going to be having a look at and pop at their firms, frankly, in a way that I think clients would not have done in 2008, and certainly not in 1991.
Yeah,
but
you're
interesting.
correct. Yeah.
Yeah, and interestingly, Stu, and you know, funny enough, when you said sort of, you mentioned length of time, what I wonder whether you were going to mention, because I noticed the Skipton product, the duration, the mortgage term is a maximum term of 35 years. So of course, you know, what the lenders have started to do over recent years is push the standard term from, you know, it's always been 25 years for the length of our careers too. But of course, what people don't realise is that really removes the wriggle room in the event of the borrower having a problem. Because one of the options available and open to a lender if a buyer is in financial difficulty, a borrower is in financial difficulty, to say, well, okay, you've got a 25-year mortgage, you know, well, we'll add a few years to the end of the mortgage to ease the pain a bit now. But if somebody's already taking out a 35-year product, Stu, that flexibility sort of goes, doesn't it? Or is massively, you know, reduced. But yeah, I mean, I wonder whether, you know, one of our friends from London Money Brokers would like to come on and have a chat with us about this, because I think it's interesting. I think there's quite a lot of differing views out there, but I do think, as you say, Stu,
from my position is, I don't want to sort of, you know, pour scorn over the whole thing. There are good, you know, news vibes about the product. It will help a number of people, and plenty will probably benefit from it. My concern is everybody understanding the risk.
Yeah,
that's my kind of point that I suppose that I would, you know, really want to get across. And from what I've seen being reported, nobody's talking about that risk. Nobody's talking about negative equity. So I don't mean to kind of put people off, and I'm certainly not saying that this is a bad thing, totally in general. What I'm saying, and my point is always that, you know, does everybody purely, you know, really understand the granite detail of the offer and what it means in numerous different circumstances?
Yeah, well, and also, Stu, perhaps to conclude this session, this chat, but of course, I suspect again that the chains where we have somebody who's getting 100% mortgage, they are more likely to be simultaneouses, because of course there's no deposit on offer.
Yeah.
So, you know, if a buyer who's getting 100% mortgage defaults, well, of course, their seller is entitled to the 10% under the contract.
You've pinched my final point.
Sorry.
And that was going to say, those that didn't live through that previous time wouldn't know. But we were exchanging, or we were faced with the conundrum that, do we exchange contracts on a nil deposit? Do we exchange contracts on the deposit being the value of, say, stamp duty, legal fees, land registry fee, or do we actually do a simultaneous because the money's not available? And it's very different, you know, being at the bottom end of the chain, because you have to explain to the client that actually your liability could be the whole chains. But again, you potentially might have somebody that doesn't have any money, because why would they be getting this mortgage product if they had more money in the first place?
Yeah, they don't.
But if you're then second up, third up in this chain, okay, and you have assets, or, you know, you have equity in your property, you still have a contract made between a buyer and a seller, and you could still be defaulting. Your point may be to go back to your buyer, but of course, if your buyer doesn't have any money, you are faced with a potential conundrum that, you know, the lengths we had to go all those years back to explain this was quite something. So, you know, it brings all of that back into the arena.
It absolutely does. And I bet you that somebody would jump on social media and say, well, Stu and Lorraine, you're talking a load of old rubbish. You know, we did loads of simultaneous exchange and completions during COVID, and it was all marvellous. Well, I'd just like to remind people that COVID was just an extraordinary
time,
difficult, you know, window of absolute, you know, in extremis circumstances, and everybody during COVID was working to, you know, desperately try to make those moves happen. And that pressure, that time, that very bizarre bubble that we were all in, we're not in that anymore. And, you know, we both know from bitter experience that if an entire chain decides to move a week on Friday, you know, and there's some git in the middle that just says, no, doesn't matter. You know, we have no contract, and everybody's got lots of costs, lots of expense, lots of inconvenience, and no binding contract. And that's, as you quite rightly saying, conundrum's a really good word.
Yeah. And also in this market, a market potentially where, and I use the word potentially, prices of properties may fall.
Yeah.
Giving people the right to reoffer or to pull out if you're doing it simultaneous, and people's personal circumstances, while the economy is as it is, are more, let's just say, risky than, you know, in good times, shall we say?
Yeah, absolutely. So, well, I hope we've sort of come back with a bit of a bang there, Stu, really, because you know, there's certainly a lot wrapped up in that one headline, really. So, well, let's see if, as I say, one of our lovely broker friends wants to come on and chew the fat with us, because I would be, you know, I'd be interested to get the more positive view. But what I think we're both advising our lovely conveyancer colleagues or suggesting is, remember, suggestion's not advice, is you know, urge caution, make sure your firm's reports are, you know, bulletproof, and that your clients understand the risk.
Most definitely.
Excellent. All right, Stu. Well, I'll see you very soon, mate. You take care.
Take care. See you soon.
Bye.